We first talked about these when they were like 2.5 times earnings. And I do think this is a kind of fun place to start with you today. Why not declare victory? Wow, they've been on a great run, but you're not bailing on them yet, are you?
No, first of all, Kelly, they're not that expensive. The demographics are super in your favor. I mean, there's since the global financial crisis, lots of folks postponed buying. They're entering the market now. There's the the supply shortage. But the real thing is that these home builders are making so much money, they can afford to subsidize the mortgages.
Right.
So if you get on the Toll website, you'll get not a mortgage for 7.5, which is kind of the average. You'll get one for 5.5.
Wow. And
you'll get it through Toll Mortgage Company. And all of a sudden, you're thinking, wow, I can afford to buy that house. And you jump in, and the economics work for both parties, and the home builder's making a ton of money.
Is there a reason you like Toll and NVR in particular? I mean, are you wary on the others, or just you like to do stocks instead of ETFs?
No, I mean, everybody's got to do their own research.
Yeah.
We like these as kind of a barbell. NVR is like, I like calling them the Berkshire Hathaway. They never split their stock. They don't take any land risk. They're very conservative, and they keep marching ahead, but they're a little more expensive than the others. Toll Brothers is the high-end. Average price of a house at Toll is almost $1 million.
Wow.
So, but they're giving these cheap mortgages. It's a very strong market. It's probably better than the entry-level market. So we play that two different ways. But if you do the math, the honest answer is they're all very correlated, and they'll work pretty close together.
Exactly. No, that's a great point. So let's kind of pivot from there to talk about the other parts of the market that are super cheap. I mean, Verizon is one example. Right. This is a fun stat. The dividend yield is now higher than the multiple. So maybe it's 8% and 7% or something like that. But isn't that traditionally a value trap kind of sign?
It could be, but I want to point out Verizon, there's lots of companies that have a yield higher than the multiple, but they're going out of business.
Right.
This is an investment grade company that has an 8% safe yield. And, they're not growing by leaps and bounds. This isn't a rocket science pick. This is more a sale close to shore. These guys will hit their numbers. It's investment grade. It's at 7 times. Maybe it trades at 11 times over the next 2 or 3 years, and you get a 50% up in the stock price, and you're making 8% while you wait. That's kind of what we're talking about.
And this was the mystery chart we showed before the break. So you're not saying you're going to buy this and maybe make 5x your money.
No.
Is it good enough to get a stock that hopefully re-rates on the multiple a few times and hopefully we dodge recession, versus an area where you might be able to make a lot more than that more quickly, or at least that's the promise and the way it feels in tech and other areas.
And what's happening here is implicit in what I'm saying is it's the time to own a Verizon and not the time to try to find a 5-bagger. I think we will look back at this moment in time and say, what were we thinking? The Fed has raised rates the fastest and the highest number of basis points in any of our careers, unless you were born in the Eisenhower administration or earlier. So it's going to have an effect, but it's going to take a while because there's such strong momentum. That's why I think the home builders can still do well. But I think next year is kind of cloudy and difficult.
If it's cloudy and difficult, what about the idea of owning tech? Because that's one area that seems like more of a sure thing. It's not because they're sexy and high growth, and it's because we can't, even in a recession, they're the new staples. Right. I mean, and I know they're priced for that. But
and the devil's really in the details there, Kelly. I mean, it's valuation, valuation, valuation. So I like Amazon a lot because their fate is in their own hands. They're cost cutting now. They're delivering more to the bottom line. They're not building as many warehouses. And so they're delivering to the shareholder in ways that they weren't a couple of years ago. So that I like. But there's others with high multiples. And Apple, for example, is somewhat problematic. It's a great company, but it's a really high multiple. We're old enough to remember Apple at 12 times earnings, not 6 or 7 years ago.
Right. When it's just a hardware company, and maybe it still is. We've come full circle on the show now with our Apple bears, so we'll leave it right there. Chris, thanks so much for your time today.
Good to be with you again,
Always
Kelly.
appreciate it. Chris Grisanti with MAI Capital Management.